Michelle, your tax advisor from TSTK Tax Tech. Welcome back to our course series of UAE corporate income tax. In this episode, we'll cover 3 key points. First, in a UAE, what financial documents companies need to keep. Second, how long these documents should be kept. Third, the corporate income tax rate. Let's begin with the financial documents. So what kind of documents we need to keep for tax purpose? Well, there are 2 types of them. First type is the supporting documents of your tax declarations. These supporting documents include sales invoices, purchase agreements, and import-export custom records. These documents provide vital information about our sales and expenses. Second type of documents are those related to tax profit calculations. This category includes your financial statements, methods used for depreciation, and documents concerning provisions for bad debts. In the UAE, tax authorities might request financial statements like the balance sheet, profit and loss statements, cash flow statements from companies. In order to create these financial statements accurately, you also have to maintain records of your fixed assets, accounts receivable and payable, your vehicle registrations, and your employee payrolls. If you need templates for any of these financial documents, don't hesitate to get in touch with us. We're always happy to help. So, how long do you need to keep all these financial documents? For tax purpose, companies are required to retain their financial records for 7 years. This means that the records from each fiscal year must be saved and kept for an additional 7 years. For instance, financial records from 2025 need to be kept until 2032. The good news is that you don't have to keep the original documents. A clear scanned copy are good enough. To make the whole thing easier, companies can use financial software with cloud storage, ensuring their financial records are secure and easily accessible. Next, let's talk about the corporate income tax rate. There are 2 rates, 0% and 9%. If a company is in a loss or its taxable profit is less than 375,000 AED, the company needs to file corporate income tax, of course, but the tax rate is 0%, meaning no tax to be paid. However, if the taxable profit exceeds 375,000 AED, the portion above that level is taxed at a rate of 9%. So here's an example. If a company's taxable profit is 1 million AED, the taxable amount would be 1 million minus 375,000 AED, which equals to 325,000 AED. Using the 9% tax rate, the company's final corporate income tax amount would be 56,250 AED. So now you know that corporate income tax come in 2 categories, 0% and 9%. Similarly, taxable entities are classified into 2 types, tax-exempt entities and general companies. So let's talk about the tax-exempt entities first. These companies, also called qualifying free zone person, they are registered in a free zone and earn their revenue from tax-exempt business activities. General companies, on the other hand, include all other businesses except the tax-exempt companies. Different types of businesses have different tax rate calculations. As mentioned earlier, the 0% rate for the initial 375,000 AED applies specifically to general companies. For tax-free businesses, the income earned within tax-exempt activities falls under the 0% tax rate. Any income earned outside of these tax-exempt activities is calculated at 9% and doesn't qualify for the 375,000 AED deduction. Let's consider a manufacturing example in Abu Dhabi. Imagine there's a factory here that sells and exports its products. These earnings are tax-free. But sometimes this company also trades raw materials, like buying materials in Abu Dhabi and directly exporting them to other countries. The money they make from this trading is not tax-free. So if the company earns 200,000 AED from this trade, they have to pay a 9% corporate income tax, which amounts to 18,000 AED. Calculating taxable profits in this case can be complicated, as you need to know both direct and indirect costs. If the earnings from these taxable business activities exceeds 5% of the total income of the company or go over 5 million AED, this company loses its tax-free status and will be treated as a regular taxpayer, a general company. In this case, it would be better that this manufacturing company establish a separate entity for these taxable transactions. By doing so, it will simplify the tax calculations and also mitigates the risks of tax violations. That wraps up today's video. If you have any questions, please contact us or leave a comment below. Also, don't forget to hit like and subscribe to our channel for more information on UAE tax. Thanks for watching. See you next time.